Um, all right. So, there is no shortage of stuff going on here, and certainly in the markets. Um, I can't remember in all the years I've been investing professionally as an advisor and fund manager, and now semi-retired and providing this research service. I can't remember too many years where I kind of felt like I couldn't really at this time of year divert my attention too much from what's going on in the markets, which is fine because I'm a total market file. And I love this stuff. And I love talking about it, teaching it, sharing ideas. But we've got a whopper of a market environment going into next year. And the reason I can say that, and kind of leading into, let's say, the lead topic for today. Uh, so I went through, and this will be my next article on Seeking Alpha. You're going to see today that a lot of the things that I write on Seeking Alpha multiple times a week, they really do kind of dovetail with what we do in the Sun Garden York portfolio service. And I'm going to try to take advantage of the that kind of symbiotic relationship between what I write publicly and what we do in here, and just kind of bring it together every Monday at 4 o'clock. And actually, in a couple minutes after I go through the forecast, which was the subject of an article, uh, I'm actually going to try something which I hope folks like. Let me know if you do or if you don't. But I'm going to actually go and take some highlighted comments from my Seeking Alpha articles from the past week. You might have seen, if you got the invite for this session today, we're calling it SAQs. It could be Seeking Alpha questions, or um, it could just be Sun Garden answers questions, and because I just think that it goes hand in hand with what I'm doing, not just in the service, but just in general, what my bottom line thoughts are. So, um, when I was going through and creating my forecast for 2025, which is a normal thing they do at Seeking Alpha, they ask us, they actually have a competition, uh, not counting on winning, but a lot of entries, but it's a competition. And so, in addition to a regular article that goes out, so obviously, I really thought hard about it, but at the same time, it's very narrowly focused. It's not as broad as maybe I'll do next Monday, where I talk a little bit more about 2025, heading into it, and kind of look at things from a broader macro than just the S&P 500, because the S&P 500 is probably about as well, let's see. There's an old Yiddish expression. It's about as fakakta as not. And I didn't say what you think I said. I said fakakta. It's about that much as I've seen. The S&P 500. It's the stock market because so many people have money in it. Biggest crowded trade I've ever seen. However, it is not a reflection of stock investing in general. That said, dividend investing is in a strange state, a real state of disrepair. Matter of fact, one of my favorite rock artists, now deceased, but I was a big fan of his, still am, Warren Zevon. And the last song that he recorded, he was on his deathbed. He knew he was dying. He had mesothelioma before anybody knew what it was, 20 some odd years ago. And he wrote a song which ended up being kind of a hit, and Bruce Springsteen actually played the guitar on it, which was kind of neat. And it was called Disorder in the House. So I was going to go with Disorder in the House, but I thought that was too negative, because my whole thing is I don't know what's going to happen. I just know when risk is high. Let me just see here, a bunch of other people coming in, so let's let them in there. Good. So, so Disorder in the House was kind of the runner up of the title of this. Instead, I went with the takeoff on Lady Gaga's On the Edge of Glory, which I found out when I researched it was actually a song that she wrote in, I think, about 30 minutes time as she was sitting with her dying father and thinking about how he was going on to the next level. Yeah, and so going out, on an edge, on the edge of glory. In this case, I think the market is on the edge of glory. That doesn't mean that risk is going to turn into reward, but it does mean that I believe as we head into the new year, specifically for the S&P 500 and looking at a full year, because that's what Seeking Alpha's prompt was to us, I do believe that risk is far greater than reward. If I'm wrong, the S&P will go up 20% for the third year in a row. If I'm right, who cares if I'm right? Because it all depends what you do about it. I quoted one of my heroes in the business, Stephen Leuthold, who's since passed. His firm is still quite awesome. Quant firm where I kind of learned a lot of my technique from back in the day. And he says our predictions are for show, but our asset allocation or our investment strategy is for dough. And I completely buy into that. So let me try to summarize some of the things here. This is on Seeking Alpha. If you're not signed up for Seeking Alpha, why? It's like $300 a year, and you don't just get my stuff. My stuff's a small fraction of what's out there. And great tools, things like that. Nobody pays me to say that. I've become a big user of the platform, not just a writer on it, where I've written, I think, something like 420 articles the last 2 years, and that is not like an Elon Musk, marijuana joke. 420. That's about how many articles I've written in the last 2 years. So let's look at this. Hopefully you can see this, but I'm going to go through it. This is a summary table I came up with for that article, just to kind of summarize it. I mean, look, we can point to the bottom and say, frankly, I'm going to talk in a little while about why I do think that a lot of investors are really missing the boat and setting themselves up for a whole lot of hurt. Not because they don't know a lot about investing, but there is an arrogance factor. I call it complacency here, but and I actually mentioned the word arrogance. But part of it is, I think, the way that we are all trained by media and, dare I say, social media. We focus on the wrong things. So as an example, and I'll show you this in some of the comments from my articles recently, because it's what prompted me to say, we should spend a few minutes every week on what people have said about my articles and how I responded to them. I think there's a lot of learning there, and at the end of the day, that's what we're here for. So some people would look at anybody's article and say, "Oh, you think the S&P is going to 4,800? Wow, you think it's going to fall 20% next year? Wow, okay." And they'll say, "Well, you're an idiot for thinking that." Okay, I don't know, guilty as charged, I don't know, but or they'll say, "Oh, well, you're really copping out here with a big range, 6,800 to 4,000." And my response to all that is, who cares what my forecast is? What is so much more important, like the late great Steve Leuthold said, is it's not the predictions, it's the strategy, the implementation of the strategy. So yeah, I do think that there's a much better chance than not that the S&P will fall next year. It's also possible that it could be like the year 2020 when the pandemic hit, obviously not because of the same reason, but I mean, the market started up that year, then it fell 33% in 5 weeks. I'm happy to say that one of my claims to fame is that I actually made 2.5% in my main core investment portfolio when the market fell 33% as part of the audited record. That is not a brag. That is simply to say, you don't have to just sit there and take it. And and the trap I think a lot of investors fall into nowadays is they're so focused on stuff like this, uh, and not the thought process that says, wait a minute, if I do agree with Rob Isbitz and risk is far greater than reward, well, what do I do about that? And obviously, in the service, Sun Garden Yacht portfolio, we are constantly showing the examples of that, and I try to do chip in some ideas from that here. But I'm going to walk through this in a sec, but let me just give you one thing that I would say is, to me, I don't just make this stuff up, even if maybe some folks in the comment section think so. But so here, this is, you can't really see this, okay, but this is something I did this weekend, and it was right around the time I was writing that forecast article. So what I did is I looked at the S&P 500, and I don't mean the S&P 500. I mean 500 stocks in the S&P 500, every single one of them. I've been charting so long, 44 years, since I was 16. And so to me, it's kind of what they call in baseball, a twitch response, hitting a baseball. Doesn't mean I'm going to hit the ball hard every time, or that I'm going to get a hit every time, but I can make assessments fairly quickly if need be. So I decided, okay, let me go through the 500 stocks and let me write down all the ones using weekly charts, which is more than just a swing trader time frame. Maybe not that far out as the entire year, but again, just like in 2020, the year ended up positive, but boy, did it start out in a hole. Okay, just as the year 2000 ended up with the NASDAQ, I believe, memory serves, spiking something like 40 to 50% to start the year in the first 9 weeks of 2000. What happened after that? It fell 75% before the year was over. So look, I don't know if we're going to get anything like that, but if we get something that, smells a little bit like that, it's a pretty foul odor, no? And, I'm seeing things that remind me of that, having looked at millions and millions of charts literally over the years. And so when I went through the S&P 500, which was a lot faster to do than it was, 25, 30 years ago, or even 44 years ago, when my late father and I were charting by hand, graph paper and pencil. Let's see, I'll estimate this, but I'm going to say it looks like there are, out of the 500 stocks, how many would say I have at least reasonable confidence that they will go up next year? Anybody want to guess how many I came up with out of 500? Any guesses in the chat?
I'll guess 50.
Okay, good. Thank you. You're a bit high, but yeah, I know, right? So the number is about 30. I'm going to, in fact, there are so few that I'm going to be able to display them all 30 roughly, in a article for Seeking Alpha, coming up probably later this week, sort of a follow-up to this one. So look, that's not the only indicator I'm going to use. It's certainly not the only one I want anybody else to use, but with that as kind of a lead in, and let me make this just a shade bigger there. Hopefully people can see a little bit better, and try to get out of this mode too. Okay. So here is my high-level summary, and certainly read the article if you're a Seeking Alpha subscriber. By the way, if you're not, I think they're having something like a first month $5 or something and no obligation. So again, I'm not here to necessarily pitch Seeking Alpha, but it is a gateway to get my work there, and the work of a lot of other folks who it's crowdsourced research, and probably about the only one left of its kind, because it hasn't sold out to the Google machine and the SEO and all that stuff. It's not an ad-based platform. So with that said, Here are what I would call the major influences. So first, and again, we're talking S&P 500. Next week, I'll come back and I'll talk a little bit more broadly, and I'll probably be, flashing a lot of charts at you to kind of show it. It all comes down to the same thing: reward and risk. Okay, there's always reward. Anything can go up at any time for any reason. All right. Uh, why is Tesla going up right now? Okay, I mean, yeah, there's probably some fundamental reasons that are part of it, but there's also some others, and could not have been forecast before the election until we knew the result. So just things can go up at any time, but the question is, how much risk are we really taking when we do that? And that is what I really try to keep controlled at all times. So this is about as concentrated a market as I've seen. It's pretty close. I think this number was 35-40% at the dot-com bubble peak. The 10 largest stocks are 37%. I do not think that at the dot-com level, and I have to check this, but the 25 largest stocks in the index are 50% of the S&P. So 500 stocks, 25 of them is on one side of the ball, if you will, and 475 are on the other side of the ball. So that is unnatural. It's also why, if you look at ETF symbol RSP, which is the equal weighted S&P 500, same stocks dramatically underperforming. And what that tells me is the market has probably pulled forward years worth of return, but it can keep doing it. You don't know when it's going to end. The other thing is, okay, indexation. This does not get enough publicity, and it's not the type of thing that I can necessarily write kind of ticker-based articles about too much. So I try to pop it in there as much as I can. But it's like, if you don't know that this is going on, or if you ignore it, like a lot of the commenters to my articles have been doing, I think you're setting yourself up for a colossal risk of loss. So 38%, okay, ETFs are, I think, approaching $11 trillion in assets now. Maybe the reason why most people don't know 99% of the 4,000 nearly ETFs that exist right now in the US is because only 7 of them, that are all effectively S&P 500 funds, it could be total market, whatever, but the US is 70% of the global market. So even a global fund probably looks a lot like the S&P. 38% of that $11 trillion is in 7 huge funds. So we've got concentration in the market itself. We've got indexation in the way people are putting their hard-earned money to work. Talk about 401k impact in a few minutes. So look, to me, this is where the bubble comes from. Not so much valuation, but valuation is definitely not cheap. And in more recent history than dot-com bubble, PE and price to sales ratios of the S&P 500 are near late 2021 highs. 2022 turned out to be the worst combined year for stocks and bonds in 1 or 2 generations. And let's face it, long-term interest rates are not falling as fast as a lot of people would think. In fact, they're rising. And that could end up being the big tip-over source for the S&P going into next year. I'll be writing about that on Seeking Alpha pretty soon too. Because this is what the charts tell me. I don't tell the market what to do. I just try to interpret it and make the best decisions based on what I see. So the other thing, and I talked about this before, there is historic complacency. There's a lot of a recency effect. Anybody who has not been investing for probably 20, 30 years or more, if they haven't done the history lesson for themselves, or just don't have a natural risk management posture, then they're going to fall for the idea that, oh, markets go up when they go down, you just buy the dips, et cetera, et cetera. Not to mention, this is maybe more for the younger crowd, okay, everything's become gamified. But unfortunately, look, we're all computer savvy. We all like our form of, could be playing, Wordle and Scrabble or Words with Friends and, whatever, or, betting $5 on a football game, or, betting dollars on horse racing like I like to do for fun. Everybody's got their outlet, but this is serious money. So I just think that there's a blurring of the lines, and as a result, it makes a lot of investors extremely arrogant and unprepared. And if our service and the articles I write and the stuff we do like this on Mondays, if it does anything in the next year, I hope that if things don't go well, that there will be some people that will say, well, at least it wasn't hitting me as it was happening, because who could have ever thought that this would happen? Okay, I've been through too much of this stuff, and I was as a fiduciary. I'm not anymore. Sold the practice 5 years ago, but I've been through it as a fiduciary. So as a non-fiduciary research provider, I still feel the compulsion to speak to people about this. Not to say the market's going down, the market's going up, but that you should be prepared for anything. And what leads me to believe that risk is high? The technical price pattern. Okay. I could have put this at the top because it's way more important than everything else to me. That's been my conclusion after 30 years of doing this professionally. Now, look, it is inconclusive right now, but like I said, okay, it's elevated. The market is elevated. A lot of parts of the market are elevated. And this is extremely, I think, concerning if you're one of these all-in, I'm a 20, 30-year investor, it won't affect me. I think emotions come in after a while. There are a lot of historic parallels to 2000. Like I said, too many to mention in this space. It was only a 3,000-word article only. But for those of us who remember, like I say, okay, so I'm trying to sort of speed up and put in concise terms what I've seen in times that remind me a little bit like this climate-wise. With that said, if the market goes up 30% next year, I will try to get my fair share of it. Doubt it'll be 30, but it won't be 3 because I'm guessing one way or the other. This is not about guessing. It's about what I call playing offense and defense at the same time. And then systemic. This is also extremely important, and I think extremely misunderstood by a lot of investors. There's so much leverage out there. The option volume. I mean, I feel like saying, am I right? I mean, those of you who have read or have seen, or if you're active in the options market, like I tend to be, in the strategy that I run for SunGard New York portfolio, but also a lot on the side, little trading accounts, things like that. The options market used to be like for professionals and for savvy do-it-yourselfers who got themselves up to speed. Now it is hard to distinguish from fantasy football. The only difference is fantasy football is in their playoff time right now. I understand I don't play it, but I know a lot of people who do. They're in their playoff time. Well, options every day is a new day. That's what zero DTE options are. 0 days to expiration. So I'm very well aware of that because we do use option-oriented ETFs. I own put and call options on some type of broad market S&P or other measure in the YARK portfolio almost all the time, except when volatility is very high and the options become too expensive. But right now, if the market flies higher, that's what a small call option position is for. If the market crashes, in a couple of weeks, that's what the puts are for. It takes out, and that's not the only way I do it. There's a lot of ways to play defense, but that one in particular, to me, the best way to use options is not the only way, but the best way to use them is to put up a limited amount of capital to do one of two things. I do both. Make it so that if the market suddenly crashes or just quickly dips, we saw the Dow go down, I don't know, 10 days in a row, something like that. Value stocks are down. We're down 11, 12 days in a row, something like that. So, if it's a slow bleed, it works the same way, as long as it doesn't take, let's say, a year or two to play out. If the market falls suddenly, you don't have to panic if you've got a little bit of money in basically like your fire insurance. At the same time, since I tend to be a dividend-focused investor, if the market flies higher, well, I'd like to have some type of call option position where I take a small amount of money, but I can make a huge gain. And remember what I said about 2000. The market started off the year, because this could be 2025, who knows? Market started off the year with the Nasdaq absolutely roaring. The S&P went up modestly. The Dow, I think, was actually down through the first 9 weeks. The Nasdaq was up something like 50%. And I'm seeing more and more evidence that we might get something like that into the first quarter. And then the Nasdaq fell 75% the rest of the year and ended up the year down, and then ended up the next year down, 2001, and then it ended up 2002 down, and fell really hard at the beginning of 2003 before it finally found its legs. I just don't see that long-term investors, quote unquote, are going to just sit there and take that, for multiple years at a time. So I try to prepare for everything, starting with the worst case. So look, those bubbles do eventually pop. I do think that the K-shaped economy, if you're not sure what the K-shaped economy is, think of a letter K. You see this here? Okay. There's some people at the top, and there's a small number of people at the top. There's a lot of people at the bottom economically. And this ultimately shapes consumer behavior. I'm not even talking about things like tariffs and mass deportations and the wild card of, let's say, a new administration and the stated policies. But I'm not a political commentator, so again, I'll just let the charts tell me, and maybe some common sense. So those are all the risks. Boy, Rob, pretty gloomy, huh? No. Just trying to put that out there first. What can happen from the positive side? Well, for every one of these, even if I did, and I don't go around believing the market's going to do this or that, I can say, where did the evidence figures, to make it a rougher year by the time it's done. I just don't know when. But every one of these can have a counter. It's kind of like, I never did debate in high school, but I think my kids did. And, they always say, well, you have to, when you come to the debate stage, you don't know which side you're going to argue. We're going to tell you when you get there. So you have to be prepared for either one, either side. So I'm always prepared for the other side, and I think other people should be too. So, first of all, this kind of new era mentality. I mean, look, maybe we have killed the business cycle. Long live the business cycle. I don't think so, but there's a possibility. Probably 2-3 times in my career, they thought that, well, things aren't cyclical anymore. Technology, AI, etc. It puts a floor under it, or the Fed has our backs and whatever. Maybe, but would you really want to stake your hard-earned wealth, especially if you're 60 like I am, or either side of that by, I don't know, 20 years? I don't know if you want to, but everybody has to decide. So maybe this time's different, but just in case it's not, let's think defense first. That's my thing. The AI trade. You'll probably hear me talking a lot about AI this year, but it won't be this AI. It'll be talking about what I think, because my middle initial happens to be Alan, and my first name is Rob, and my last name is Isbitz. So yeah, while everybody else is talking about AI, I'm going to keep talking about what our AI, my initials, think. And look, I remember the internet bubble like it was yesterday. I mean, I was managing money professionally. Uh, and there was a belief at the time that, oh, well, this can never go bad. And maybe this time again is different. But so, until we see the follow through, it's one thing that a lot of money is going toward AI now, but A, it has to keep up. B, the companies that are using it to generate corporate profits are going to have to prove that they can do it. And oh, by the way, there's also, and again, I'm not a fundamental analyst at heart, okay, but there are concerns about how much power it uses, et cetera. Same concern they have about Bitcoin. So, is it going to be resource constrained, or is it just going to be something else that makes people say, you know what, maybe the good money's been made already, okay? Being early is good if you're right. Yeah. So then also look, I mean, productivity. Okay. I mean, maybe there is a new valuation paradigm. The S&P should never trade at less than, I don't know, 20 times earnings. I don't believe that, but a lot of people do, and maybe they're right. We've gone from this industrial economy to more of a digital economy. Obviously, at least in the US, we're a very service-oriented economy. It's been that case for a while. Maybe there's a Fed put, like I mentioned. I mean, nothing sustainably bad has happened for the S&P since 2007. 2007 to 2009 was gosh awful. We had blips every couple of years to the downside, but buying the dips has worked for so long. In fact, those of you who are really music aficionados, I was a DJ in college, like back in the 80s, so I can't get this stuff out of my head. So my apologies for that. This was the song going through my head. Hey, I get knocked down, but I get up again. The band is Chumbawamba, I believe. And they were a one-hit wonder. But if you've heard the song, it's hard to forget it. It's a very catchy song. And look, the market keeps getting knocked down. And so, we have to at least respect the fact that it can continue. And as I go through all this, keep in mind, what I see out there is a lot of people saying it's either this or it's that. And I'm saying, how do I know? Well, why don't I just account for both? And then get to a bottom line, at least for the purpose of the prompt in this article for Seeking Alpha. I have been talking about this a lot, and I think going forward, we'll get to the point, especially the next time the market either melts up or crashes, where increasingly everything that happened before the pandemic and in the midst of the pandemic in 2020 are getting a lot less relevant. 2021, 22, 23, 24, and probably 25, 26, that's probably going to define how markets work, what they reward, and what they punish because of things like algorithmic trading, hedge funds, 0-day to expiration options, massive option market volatility, investment advice becoming commoditized. I mean, it's just such a long list. Markets don't work the way they used to. That I am convinced of. The only question is, how do we try to get whatever type of edge we can? And when I say edge, I mean an edge first that makes it so that I don't have my life savings flushed because I was too arrogant or just not paying attention to how things have evolved. Or it could possibly be because the nature of market participants has changed, and we don't have as much say, or I should say the fundamental approach doesn't have as much say over market activity as it used to. And that's my point here. There's also, look, there's a lot less regulation. I cannot believe the stuff that people get away with. I remember the very tight guidelines I had to follow as a investment advisor with the licenses and the whole thing. I'm about 4 years post licensure, since I'm a researcher and a publisher now, not a personalized advisor, as everybody knows. But you know, and we don't know what's going to happen in terms of what the new U.S. administration is going to do, what some other government changes outside the U.S. are going to do. But you know, that could, you know, as some have been quoted, you know, there may be some short-term pain. I don't know, does it help corporate profits or not? Again, to me, all of this will come out in the wash through the charts and through sentiment, and to some degree, you can tie it back to fundamentals. But at the end of the day, the worst feeling in the world, I can tell you, as a sort of recovering fundamentalist from decades ago, nothing feels worse than saying, oh, our rationale was so right. How did I lose all that money? You know, that's why I really bought into the approach and the process that I have, but I don't expect anybody to necessarily buy into it. But that's why we speak about it. So let's get to the conclusions. It's high risk, but it's also high reward, because it always is. But it's not a time to blow off those risks. You know, my plan, as always, keep exploring, keep considering the many ways to play offense and defense at the same time. ETFs, stocks, options, cash. I have no idea why I left stocks off of here. My bad. You know, I looked at the chart. I can't say I looked at it for hours, but I said, okay, let me look at some familiar levels. Let me think about history. Okay. And people forget, you know, if the market went from, I don't know, the 6,000-ish area, a little bit below that now, to 4,000, would that be so crazy? I mean, you know, it happened during the pandemic. It's happened multiple other years. This, to me, is a rubber band stretched more than most rubber bands have been stretched in you know, my decades of doing this. So yeah, maybe it's extreme, maybe it's not, but I'll give that as a potential low point. And yeah, I could see the market rallying 10%. Most likely to be at the beginning of the year. I didn't put this in the article for the forecast, but you know, if I were going to take, I don't know, maybe a 20-to-1 shot, I would say, and I kind of looked this up. I don't know how often the market has, let's say, had it so that each of the 4 quarters of the year was successively worse. So the first quarter was the best. The second was a bit worse. The third, the fourth. I think it might have happened a couple of times, but it rarely happens. And I mean, if we're ever set up, like I say, probably 20-to-1 odds I'll put on it, but I would take that bet, you know, for my usual dollar, like I do with the horse track. So, you know, again, the focus of the article was, okay, where do you think the S&P is going to be at the end of the year? I'll know a lot more 2 weeks, 4 weeks into January, 3 months in the year, 6 months in the year. It's like, you know, it's throwing darts, okay? But I put it all together and said, okay, my best guess among a wide array of things that will not matter unless you execute during the year is about a 20% dip. We could also get this in the first half of the year and end up at, you know, 6,000 again, 6,800. Who knows? Who knows? But I wanted to provide that color, especially if you've read that article, and even if you haven't. And if you haven't, by the way, and you're not a Seeking Alpha subscriber, let me know, because I think we get a certain number of like free, like we can send you this article. I can't send it just, you know, to a massive group of people, because you know, it's paid content on Seeking Alpha platform. But you know, we can you know, we can certainly get it in some folks' hands if they haven't seen it. Plus, again, Seeking Alpha subscription, I have no specific reason to promote it, but I think it's like $5 for the first month, and you can see a few articles for free. So if you say, hey, you know what, I don't know if I like Seeking Alpha, but I certainly want to look at this article, you probably can do it with a free subscription. I don't know for sure, but I think so. So a couple other pictures to look at. This is the last 2 years. I mentioned this before. Here's the S&P 500. Here is the S&P 500, except the purple one is equal weighted and this one is cap weighted, market cap weighted. That's a big difference, and it explains a lot. This is the last 3 years, and what this shows me is, okay, the S&P, the traditional version was let's see, down here, okay? However, if you just look at the top 100, a little higher. If you look at the top 50, a little higher than that. In other words, it's very focused at the top. How focused? Well, again, you're including 3 years here. 2022 was not very good for the stock market in general. 23 was a recovery year. 24 was another recovery year. And apparently everybody's memory is very foggy before here. And that's what I'm trying to prevent in people's decision making, on their own. So look, last 3 years, the S&P is up, what was it, about 9% a year? You wouldn't think that, right? You would think it's up way more than that. Oh, it's probably up 25% a year, Rob. No, it's up 29% total, including dividend. We forget this, I think there's probably some psychological factor, repression or something like that, I think they call it. So, so easily this is forgotten. And it takes a long time to recover if you're not a Mag 7 or similar type of larger company. Look at how well the 100 largest stocks by weight did the last 3 years, 36%, even after shaking off about a 25% decline in first 9 months of 2022. The average stock in the S&P is up a very T-bill-like 12%. Over the 3-year period. And if you extend it out to include some mid caps, the equal weighted 1,000, I love this ETF for tracking that, 7.25% in just under 3 years. These are not annual returns. These are total returns. I am not lying. This is taken right from Y charts. So the questions we should all be asking ourselves, and I kind of pulled this right from some of my recent articles, Seeking Alpha. The questions we should all be asking ourselves, or like I say, how to play offense and defense at the same time. It's a trade-off. I ask myself in every decision in the portfolio at large, because I'm big on portfolio construction, not just, picking securities, especially if they're all stocks, because sometimes they all go down together. How much upside potential do I have in any particular investment? And this is the part that most people don't incorporate in their decision-making, or at least not enough. How much risk of major loss comes with putting my hard-earned money into that investment? In other words, it's like people are saying at a very sort of Cro-Magnon level, hey, I can make a lot on that. I'm in. And they never even get to this question. And I wouldn't be saying this if I didn't see it playing out every single day. And I'll show you some examples of that in a second. So obviously, we're going to spend a lot of these Monday sessions talking about how to play defense. I've done it before. I've written a zillion articles on it. The entire probably profile page on Seeking Alpha for SunGard and Yarp Portfolio Service goes over it. I mean, defense, 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 along with your offense. That's all I'm saying. A lot of ways to do it. Well, one way to do it is to, sit on my keister and make what is still well over 4% in T-bills or T-bill ETFs. Got a pretty big slug of that in the portfolio right now. This has been as high as, I think, at 1.70% of my portfolio at points in 2022. Why? Well, bonds were getting crushed and stocks were getting crushed. And, we'd gone from 0 to 4.5%, 5% in a hurry. It's a nice little ballast for the portfolio at times. Certainly beats what dividend stocks have done. I have a study I'm working up on that too. You'd be surprised with a number like this, unless you know a number like this. A lot of dividend stocks have not covered their dividend in total return the last 3 years. I mean, a lot. Okay. There's also single inverse ETFs. And the first thing people tend to say about single inverse ETFs is, oh, well, if you hold them too long, blah, blah, blah. Okay. The math works against you. And that is absolutely true in terms of sort of letter of the law. And that's why they talk about it in the prospectus. Oh, you have to be careful if you own it too long, because if you lose money, you have to make up so much more. But look, this is the one I probably use the most in my career. It's the opposite of the S&P 500. SH is the symbol. And in the last 6 months, with the market up 15%, it's down only 2/3 of that. So again, I wouldn't, certainly not something I would probably do. But when I see this, the first thing that comes to mind is, wait a minute, you mean to tell me that if I were just scared out of my mind 6 months ago and I decided to split my portfolio between 50% in this and 50% in this, that I would not have broken even? I would have made money because this has outperformed this by 5%. That's what we call arbitrage. I've done it before with ETFs, but I don't do it to speculate. I do it because defense is important alongside offense. So there are so many different ways to do this. I'm only going to rehash some of the high points. Okay. I like leverage and leverage inverse ETFs. The only reason I like them is because I'm not a pig about them. I don't go and put 50% of my portfolio in them. I look at them the way I look at options. There's a limited amount of money. I know how much I can lose if I put up. So for instance, if I take 1% of my portfolio and I buy tail risk S&P put options, and of course the service focuses a lot on how to do that simply. I call it meat and potatoes options investing. I'm not gonna throw Greek letters at you and stuff like that. I'll leave that to the TV people who love to talk about that. To me, it's as simple as saying, all right, if I invest 1% of my portfolio in something that, if the market really falls hard in the next 3 months, 6 months, whatever the expiration date is, if it really falls hard, that 1% is going to offset a lot of my losses from my stocks, from my ETFs, et cetera. And I can do that with 1% of my portfolio. What's my worst case scenario? If I fall asleep and it expires worthless months from now, it's cost me 1% on my total return. I love that trade-off all day for me. Now, levered ETFs don't work the same way, but they do work in the same direction. And what I mean by that is, if you put up, and let's just take a 3x, and again, I'm just going to brush on this for now, certainly take any of your questions on it, but let's say it could be a 3-time levered ETF. Well, if I put 2% of my portfolio in it, let's say, actually, matter of fact, let's make it simpler, 3% of my portfolio in it, okay? So, and it's 3 times inverse. So it would almost be like putting 9% in this, except it can move faster. 3% of my portfolio. Again, if I fell asleep, I'd have to fall asleep probably for a good year or so. Maybe all 3% would get sucked out of there, and it would cost me 3% off whatever my return was. But of course, if that happened, that meant that my inverse leverage 3-time ETF did so poorly because the market was flying higher and just kept losing value. So the rest of my portfolio, let's call it the other 97%, is probably doing pretty well. So I can probably take that 3% hit. But honestly, I mean, I'll take losing 1% out of the 3, meaning it goes down 33%, would be the equivalent of about a 10, 11% market move higher. So again, my broad point on this is there are so many ways to play defense. Learning how to use them doesn't mean you're compelled to have to implement them, but a big issue for me right now, because I have the market view that risk is higher than reward. My market view is not that I think the market's going to fall, is that risk is so high that I don't think that any investor who cares about what the value of their portfolio is a year from now should be ignorant to how to play defense. Now, I'm going to say one quick thing here about SunGard Yarp portfolio, because I want to show what happens when you put this in action, albeit this is a very, very small sample size, as they say. But what I did, and you can't really read this, I'm sure, but I can certainly, put this out there in another form, because I track this all the time. So what I did is I said, okay, our brand of income or dividend investing in the purple here is a little bit different. It's different from SPY-D, which is the high yield stocks in the S&P 500, I think 80 largest yielders. Schwab Hedge Dividend Equity ETF, which is wildly popular. I see why it's popular. I don't see why it's as popular as it is, for what that's worth. Same thing for JEPI, JP Morgan Equity Income, this covered call ETF. And so, look, what I try to bring to the table for everybody that follows me, and particularly the subscribers, is I want to try to, my mind goes to places that a lot of investors' minds shouldn't go, because I've seen too much. Is an old expression from one of my favorite movies, A League of Their Own. I've seen enough to know I've seen too much. And that is the case, having done this for so many decades. So, but this is something that says to me, oh, okay, the process is working the way it's supposed to work. These are 5-day rolling returns, okay? So all this is saying is, if something is not prepared to play defense at all times in some form, even if it's a little bit, well, then you're probably gonna see your value drop a lot faster than you will if defense is part of the plan. I'm not even going to show you the numbers. It's small numbers or whatever. I mean, it fell 2% instead of 5 or whatever. But if we have something that's deeper and it doesn't recover so quickly, that ends up being, life altering from a financial standpoint. So in the brief live history, the 7-month, 8-month live history of SunGard Yarp portfolio, which is stocks at the core, ETFs to supplement, T-bills, cash, call options, put options, the whole thing kind of wrapped up for total return, and I think yielding around 9% right now. But if it's yielding 9% and it doesn't fall apart like bond funds and high yielding stock funds do, maybe there's something a little different going on here. And so this is my one, couple minute spiel, if you will, about how there is a cause and effect if you play offense and defense at the same time. And I will also note that, the performance has been, market-like in total. Play better defense, get your fair share of the offense. This is how I have always rolled. Okay, I'm going to stop there for a second, because we are about 55 minutes in, and I want to see if there are any questions here. I may suspend this to next week, depending on what folks think, but I am starting a new feature either today or next week. That feature, and we sent this out today, basically like an FAQ. Instead of, to the extent that people want to ask questions, I want to answer them, and I will show you stuff in here, with it. To the extent that people want me to supply the questions because they are coming from commenters on Seeking Alpha to my articles, because there's so much good conversation there these days, including some people that don't think very highly of me, and that's fine. That's the other part of this. So I can bring some questions in, or I can get yours. So let me stop here for a second. And first, let me say, because there was actually a commenter in one of my articles, so it was the article on Pepsi. Cannot believe how emotional people get about Pepsi Cola stock, but you know, what are you going to say? Um, you know, I look at it the same way I look at everything. You know, as I can, I can show you if you want to see, you know, a few pot shots and yeah, that's great. What I don't love is when people simply, well, it's not just me. Seeking Alpha has a policy in the comments section. You can criticize, you can state a different case. What you can't do if you want to be able to keep commenting on people's articles, the people that, you know, do the work, is you can't do what they call blanket dismissal of someone else's ideas. So simply saying that's ridiculous, you know, this guy doesn't know what he's talking about. That may in fact be true, but you're not supposed to say it, and we're supposed to report them. That's the Seeking Alpha guideline that we all sign up for. So, you know, look, there's a lot of debate over where markets are going, et cetera. So first of all, I don't know. There was one person I actually, the comment was, I would say, vile's the wrong word, but from a standpoint of everything I just talked about with investment process and offense and defense and all that, it was so vile from that standpoint that I invited that person to come and join the group for a day and, you know, tell everybody what that person sees that I don't. So I'm going to pause for a second. I don't know if they came here. I didn't get a response. No surprise, because this has happened before. I always invite the people that have the strongest opinions, which are also dismissive, before I report them. I give them a chance to show up. So let me just pause for a second. Is there anybody that might be that person that wants to address the group? Let me give it 10 seconds. 3, 2, 1. Okay, so another troll has disappeared. Very sad. Now, your questions. Now, I don't want to. I want to be very careful of everybody's time, and as such, you know, I can go into a few things here which do highlight more examples, if you will, an extension of what I wrote here. And what I just discussed for, you know, better part of an hour. But let me know what questions you have. Yes, Tub Thumping is the song. Thank you, Don. Chumbawamba did I get knocked down, but I get up again. Yeah, actually heard that live, not from that band, from a pretty well-known band whose lead singer I cannot remember, but anyway, we were on a cruise and he was on. So yeah, very cool song, very ridiculous song, but very cool. Anyhow, okay. Let me say, oh, and let me just answer this question because it's kind of subscription related. First month's cost is $80, not $5. How do we get the trial for $5 a month? Okay. So you can get a $5 trial to Seeking Alpha's premium service, which is where you get all the regular articles that we all put out. I think I mentioned I've written 400 and some odd the last 2 years. You get that from me, thousands of other people. You get all the quant stuff. I mean, it's everything. It's quite a robust package. I think it's $300 for the year, but they put out something recently for $5 first month, and after a month, if you still like it, I think it's $300 a month. That is the Seeking Alpha premium service, which is probably how a lot of people find our investing group. SunGard York Portfolio is one of several, 120, 150, something like that, investing groups on Seeking Alpha, where they all take a different shape and form. This one, we try to be a little more collaborative, and you know, we're kind of seeking out people that we think can learn with and from me, and vice versa. It's a little less of, let's call it a subscription service for a fee, because the last thing Dana and I want at this stage of our lives and careers is to have people constantly funneling in and out. You know, we want serious serial learners that we can work with and help and learn from. So that service is about to go up to $1,500 a year. We haven't announced this, but I might as well tell you because a lot of you are here. As of New Year's morning, it will go up to $1,500 a month. It is currently $975. I'm sorry, $1,500 a year. Our clients used to pay us about $1,500 a month, but it was a long time ago when I was an advisor. So it's $1,500 a year. It will be $1,500 a year. It is currently $975 a year, 35% discount. That will end at the end of this year, so in 8 days. And so that is also what is being offered first month, $80, which is about the same as the annual. You can also sign up and cancel within the first month. So it works out about the same. So hopefully that solves that confusion. Okay, let me see. We may have some other questions. I want to get to those first. Okay. Make page a little larger. Hopefully I did that before. Bomi. Let's see. Yes. All right. Okay, yes. Question. Many SA authors, Seeking Alpha authors, are very high on gold going into 2025. Gold part of your portfolio and approximately what percent? Thank you. Let me see. I don't go anywhere without my trusty charts. And there it is. And there's multiple symbols for gold. But there's IAU. Everybody can see that, right? Let's see. Let's go to the slightly longer term one. Okay, so I am going to use IAU gold, not gold stocks, although I'll look at those in a second, just in case. And you can see I've probably written about this recently because I put some markers in here, sort of points of significance, if you will. Bounces here, bounces here, bounce here, broke through a little bit. And that's what puts this in the category of, at least on the daily chart, okay? I'm looking at this and I'm saying that is a breakdown through a shortish term trend going up here. But I wouldn't say this is a downer for sure just yet. I think the 20-day exponential moving average, that's complicated as I'll speak about the technicals. This red line is one of the most underrated simple indicators that I have seen. I'm actually doing a study on this as well to try to show that sometimes less is more. So if you see this start to break down, it becomes a little more concerning. When you see it start to break up like this, it usually means good things are going to happen. Right now, it is a toss-up. As Warren Buffett would say, it doesn't go in my inbox or my outbox, it goes in my too tough box. So, and this is hinting at maybe a little downside here. So then I look over to the weekly and say, all right, let's go a little bit further. I do a 3-day chart sometimes, but let's go over here, same markings from here, but I see something over here which catches my eye. And again, nothing conclusive because I'm not one of those that just sits there and says, buy gold, sell gold. I'll give you my conclusion in a second. It's getting heavy. It got heavy here and nothing happened. So that's good. I'm only looking at a couple of time frames. I might look at some others. There's no issue here. It hasn't dipped over the 20-week. Okay. But it's had a nice run and we can't forget that. So I put all this together very quickly and on very short notice, obviously, but thank you for the question. And my conclusion is I wouldn't be jumping into it. I do not own it in the portfolio. I'm trying to think. No, I don't own it in the portfolio. I certainly track it very closely. But where would it have looked a lot better? Somewhere in this zone, okay? Like around this time, fourth quarter last year. Okay. I see all the things that I'm kind of looking for, and I see it on a weekly chart. Obviously, we'll do some charting only sessions where I can really dig into this. And sometimes gold looks terrible and gold mining stocks look good. And then there's times like this, which is another piece of evidence, another log on the fire, if I may, in the season, to, even though I live in South Florida, the gold stocks like GDX, they're already broken down. I mean, even if I'm kind of liberal with this, and still very close. Okay, but it's pretty much broken down. Look at this. That's rolling over a little more seriously. Gold stocks already appear to have peaked, and that's quite a move. Okay, 44 to 34 in a couple of months. I don't think gold has moved that much, right? So maybe the gold mining stocks are already telling us where gold is going to go. This happens a lot. And the weekly looks pretty awful as well. This is a momentum indicator called price percent oscillator. Oops, sorry, I don't want to use too much jargon today because this is just an overview, but giving you a good example using the question is my intention here. If this breaks through here, like this did here, and goes under zero, then it'll be a little more convincing. And look, I look at stuff like this, and one of the thoughts that goes through my mind is, wow, if I get this break, now I'm starting to think of it a whole different way. I'm pretty sure that there is an inverse gold mining ETF. And while it's not the biggest part of the SunGard New York portfolio, I am okay taking little shots or big shots with small amounts of money, as I like to say. That's a lot of downside. 34 to 26. It's 25% right there. Well, I'll take a chance at that with a small position to start. In my trading accounts, maybe I would do something, but that's outside the box of what we do in the service, so I won't spend more than a second on it. But yeah, there's a lot going on here. Now, you notice I did not say one thing about the gold is rallying because of this or that, or mining activity, or such and such, some big investor is buying it, or this company said they really like it for 2025. All of that exists. I just don't care. Because, regardless of what your process and your discipline is, what I tell investors is, if you're doing this yourself, develop a process. You want to copy mine exactly, have at it. That's what the service can be used for. You want to use my process like this to get ideas and then personalize it. Amen. Chef's kiss. But to simply say, well, this one said this, whatever. Okay, so you're not going to hear me doing a lot of, well, I like this, I like that, or I don't like this. But look, like the quote I used a while back today, the predictions are for show, and the decisions are for dough. And so that's why the one thing that the subscribers get that other people don't is they get the decisions one after another, as opposed to I read an article about this one or that one. Okay. All right. Let's see. Okay. Let's open this for a sec, see if there are any other questions. And then I will say, okay, we are done with, let's call it the formal 2025 part. And then I will go into a couple of additional things for only the folks who want to stay. And if there's nobody left, maybe I'll just record it, or I'll turn off the meeting. But I also don't want to leave people hanging. Obviously, this is a little more robust than we'll do most Mondays because of the topic, but yeah, here we are. So any questions? You should all be able to unmute, because I heard some people before. So you can unmute.
I've got a question, Rob.
Yes, sir. And let me do everybody a favor and turn my volume down. Go ahead, Jim.
I'm very interested in energy and the stocks, partly because energy as a part of the major indexes has declined dramatically over the years,
Yes.
but the oil industry hasn't gone away. And I find a lot of value in especially uh, large scale places like Exxon, but
Hmm.
also the Canadians, despite the problem with the exchange rate, the Canadians, there's a lot of money coming out of them, and I don't. It seems to me I heard you sometime earlier or in one of your articles that you don't like the energy issues or you don't. I don't know, but I'm
Sure.
just wondering. Just a few sentences would be fine.
Fantastic. By the way, just so you folks know, because look, we thrive on feedback. Um, yeah, whether it's in the chat if you're a subscriber or find us on Seeking Alpha. I think our email is fairly easy to find, or if it's not, just let us know. It's info@sungardeninvestment.com. We have a website. It's there too. Um, we One of the things we're thinking about doing, and I don't know if this would be, I don't know, maybe a little bit every Monday, or more likely we would just do it as separate sessions. Literally, think of it like almost like a call-in show. Come with a ticker, tell me the ticker or tell me the industry, and I will chart it quickly, and then we'll move on to the next one. Almost like the old radio call-in shows. Bob Brinker would be a name that some of you might remember.
Absolutely.
Yeah. Okay. So, as it turns out, I own this ETF in our core portfolio. It is the
Hmm.
smallest position. It is a 5% position. Why? Because I didn't think I trusted it any more than that, and this can be volatile. And it is off. It's off about 15%. Now, that's more than I often let something slide. However, remember what I said. It's a 5% position. Okay. So if it were and this is an ETF with a bunch of stocks in it. So, if it were a 15% position and we're down 5%, it would be the same impact. So I let those 5%ers go a little more, especially when even before I bought it, I'd kind of outlined this range and thought was okay, maybe it's going to move up through this range, but oil is a fickle beast, right? Especially when you talk about drillers. The only reason I'm holding on to it right now, or maybe looking for a swap candidate, who knows? But sometimes these things go down through here and they fool you and they come right back. Doesn't look like that's going to happen here, but I'm going to give it a little while at year end here to figure that out. If not, I'm out. Better fish, bigger fish to fry, okay? However, that's not the whole energy sector, but the reason I even looked at XOP to begin with is because this didn't look that good. This is like Chevron, Exxon, the big U.S. Energy providers. And I mean, again, nothing terribly inspiring. And you know what? For those of you, I think who heard me before, I charted 500 stocks in the S&P 500. I found something like 30 that I would say I was fairly comfortable with at first glance. That's not a lot. I would like to see that number at 300, maybe 350, not 30 to start the year. Okay. And what that tells me is you may not see anything this week, next week, but sometime in the month of January, you know, it wouldn't surprise me if you had a drop. But you know what? I'm still going to own call options on the S&P 500 because what if I'm wrong? Then I want to make a lot of money despite being wrong while still having my behind covered. The last thing I'll look at here, and there's a lot of ways that you can look at with this, but actually, let me see here. OILK. This is the oil price itself. And you can see, again, I say it all the time, this stuff is, some people can consider this voodoo. They can say, you're not really doing any analysis. I feel like this is about the only analysis I need to do most of the time, that and keeping up with it. So Yeah, look, I know the real world scenario or the real world situation with energy. Okay. Um, I mean, there hasn't been let's say World War III style activity in some of the world hotspots recently. Um, Something that would spike the price of oil, as we've seen. We also haven't seen a dislocation like we saw here. U.S. drilling is, still pretty fierce. Doesn't matter who the president is; it's pretty fierce. That's probably what's dipping the price a bit. High U.S. supply. Nobody else is really offline. Again, I can talk to fundamentals like anybody else, but at the end of the day, all I want to do is ask the market, what story are you trying to tell me with the price of oil? And right now it's saying, I don't have much of a story, especially on the positive side. Not that much on the negative side either, but as you see, I have been losing a lot of money if you were invested. And yeah, I haven't made up my mind yet. However, if you see me drop below here, and even below here, then you better watch out because I could go here and that's half of what the value is now. That's just me almost creating a character. Maybe it's time for some animation. An animated character. What is the market telling us? What story? And that's what oil is telling me right now. Okay. Any follow-ups on that, or should we take a couple more? Good. All right. Anybody else, either in the chat or through here, through the live? Yeah. Okay. So for those of you who are left, let me just show you what I have, and you can decide if, we were gonna go over, let me see if I can actually find it here. Okay. No, we are not ready for prime time yet with this. Yeah, actually, I can talk about the depth chart. I can. So you've heard if you're a subscriber and you're in the chat, you have seen us talking about something called Snowball, and it has nothing to do with the time of year. Snowball Analytics. Check them out. I have no business ties that I know of to them, but I went looking. Okay, when I was an advisor all those years, I had first class portfolio reporting, every which way, slice and dice, and of course all that went away when I stopped being an advisor and dropped my licenses and retired from that business. And I've been looking to get it back for 5 years. And I finally, through testing 3, 4, 5 different systems that all looked pretty good, but were some degree of clunky, we finally found Snowball Analytics. It's cheap. I cannot imagine. I think it's like $110 a year or something like that. So price is probably not an object. And maybe what I will do, I'll either pre-record or more likely I'll just take a segment of either the next one or early next year, or maybe we'll put a blog out just pointing people to it. But it allows you to take your own portfolio and it basically reports on it like you're a professional investor. Returns and holdings, and it accounts for the dividends instead of like on my Schwab where it says, oh, you are down 5% on this. No, I'm not, because AMZ or Aptly or whatever, one of those yield max ETFs just pay me a 6% dividend over the last 2 months. So I'm actually up, not down, stuff like that. Okay. It has everything dialed in. And the other thing we figured out, and I will pull this up here. The other thing that we figured out is that it is so good that instead of having to what do I call it? Paralysis by analysis. You can see. And by the way, if there's anybody here, because I know a lot of our subscribers are on still, you can see we're shortening this. We're shortening this. We're cutting out a lot of the what I would call the likely overkill. Okay, all the different ratings and how do you get to it and whatever. We're happy to use that in discussion, but we've put it out there a few times and we've kind of gotten crickets when the question was, do people really use this stuff like a research database? Snowball is not a research database per se. However, it's going to give you some of that information. More importantly, instead of the portfolio, you can see this as a Friday, okay? Probably starting tomorrow for subscribers. Instead of this, which admittedly is a little awkward and it doesn't record this correct, this is just us taking it, you know, from our account, cutting out the dollars and all that. You know, this yeah, plus it's a lot of work. So instead, what you will see is a beautiful copy, basically, of my portfolio, and it basically connects you to the Snowball system so you can poke around in it. I don't think you have to be signed up for Snowball. Maybe you do. Dan is checking on that. But this is such a breakthrough. I can't even tell you, and I certainly can't describe it, you know, as good as it is. So instead, I will simply refer to this. If you are a subscriber, and if you're not, this is probably good for you to see. I think what we have concluded a couple months into this, and plus we were on Substack for like a year. So, I mean, you know, we're so feedback driven here, because look, I may find something valuable, but you know, I do this all day, you know, every day. So what we did instead is we replaced the things that were potentially data and research overkill with what I would refer to as actionable. Okay. So what do I mean by actionable? Well, this is, and I mentioned depth charts several times in the past. Well, I actually created a more easy to use depth chart than I think we've ever had. And it's simply a tier system. We have a whole guide to it here. We're doing this for the stocks and the ETFs. And basically, think of it this way. This whole discussion from today about playing offense and defense at the same time, looking at the risk of things, not just the reward. It all comes down to, okay, Rob, for this security or this stock, this ETF, what do you really think? Well, I can sit here and say buy, sell, hold. Okay, and we have had this in the little guide that I created. But come on, buy, sell, hold, strong buy, strong sell. Like, what does it mean? It means something different to everybody. And no matter how many times I put it in my Seeking Alpha articles, you know, there's still some dude, let's call it, that says, you know, well, you had a sell rating on the S&P, blah, 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 blah. It's like, you know, there's so much more to it than that. And, you know, as they say, if you force me to pick a rating, I'll do it, but there's always an explanation. Because investing doesn't work that way. It says, I say, it's not black or white, it's always shades of gray, not a movie reference. So what we do is using our familiar color bar to a lot of you, say, okay, if I'm owning it in the portfolio and it's what I would consider a stable holding, I don't think I'm going to sell it in the next 14 days. Might not sell it for much longer than that. But, you know, that's as far ahead as I can look with a high degree of likelihood. So the greens, all right, and to put it the way one subscriber brought this up on a recent call like this was, you know, Rob, if you bought something and you bought it a few days ago and you're already up 5%, if I'm that fortunate, how do I know that I should still be able to buy it? Well, if it's green, I'm not telling you what to do, but I'm telling you I don't think I'm going to sell it. Okay, at least not right away. if I think it's more likely that I could sell it, not will, but could, I don't know what the percentage would be. I don't know, 50%, maybe less, but at least it's, it's not what I call a fresh money buy, maybe like this one might be. That would be a blue. If it's on the bubble, I have no idea. I just don't care. It would be gray. I'm sorry. I just described the yellow. If it's off the radar, I just don't really care. That's a yellow or a 4. On the bubble basically means there's a good chance, not absolutely, but that some of these grays could be swapped out for some of these blues. It's not like it's 1 for 1, but this is, if you will, the bubble right here. Okay. Your teams in the NFL playoffs, or are they? They're sitting at number 8. They're on the bubble. If they win and the other guys lose, they're going to end up in the 7th spot or the 6th spot. Okay, it is a timely part of the year for that. That's what this is. These guys have already made the playoffs, at least for now. These guys are kind of in the middle. And if you're fighting for the first round, for the first pick of the first round in the draft, like my New York Giants are this year, and our friends the New York Jets, then you have this. All right. So the depth chart summarizes all of this and basically says, okay, there's 3 stocks that I think ought to be in there for a little while. And I'm probably going to update this today or tomorrow. I'll update at least once a week. And if it's significant, I will update it too. So there's only 3 stocks that I would say are kind of, out of the woods. There's a bunch of here that are possible. And this is because I see so many lousy patterns. And so, maybe I don't have my finger on the sell button just yet, but I mean, who knows, there's also tax ramifications, but we don't really cover that in the service. There's only one that's kind of in the middle. There's a bunch that I don't really care about, especially the ones I just sold. And there's a bunch that are nowhere near. Now, look, before it becomes a 1 and gets in the portfolio, it has to go from 5. Maybe it'll skip 4. Maybe it'll get on the bubble unless something really dramatic happens. And then after the bubble, it ends up in here. And then once it's in here, well, potentially it gets dropped down here, or, it's not out of the question that it could go from 1 to 3. And the same thing is applied to the YieldMax ETFs because they're kind of a special breed. The other income ETFs, I have one stock in there, my first kind of growth stock, Boeing, off to a good start. The growth ETFs, which we'll probably see more of if the dividend space continues to look like it does, which is not good, and the bear ETFs as well. And, this is free space to add things. So if you have any suggestions on what you'd like to see, but I like this snapshot personally a lot better than what we had because it pretty much tells you. If you want to know what I feel best about stocks and ETFs, look at 1. If you're looking at the stuff that may be on the way out, maybe you don't want to buy it right away. Maybe wait till these go to the 1 area. Okay. And these, not too many on the bubble, but there's a couple of them. So that's the depth chart. And hopefully this is going to bottom line this, make a lot of this much more actionable for people instead of throwing a lot of data at you. Okay. Any questions on the depth chart? Any questions on anything else? I don't want us to go any longer unless there are questions. And I think next week we'll talk about some of this stuff, or maybe I'll blog it too. Let's see. Oh, somebody did ask, Bomi, let's see. So will subscribers have access to all your research and commentary? Absolutely. That is what the service is. It is. We didn't call it Sun Garden Direct because nobody would know what that means. Because they don't know what YARP necessarily means either. Yield at a reasonable price, but that's up my trademarked statistic I use for dividend investing. But the service is bigger than that. So let's see. Yeah, so that is how you get the service. Like I said, it's $975 a year for another 8 days, and it's going to go to $1,500 because it is intended to be kind of not for everybody, but definitely a fit for the people that are in sync with it. Let's see if we can not join your live sessions. Yeah, due to work. Yeah, we figured that would be an issue. We record the live sessions. I'm going to try to get better at keeping them a little bit tighter. But obviously, we're still kind of like at the end of the launch phase of this thing. So we're trying to figure out, what works and what doesn't for the audience. And you are welcome. But yeah, how soon will the recordings be posted? Pretty soon. We're going to try to make them almost instant. I'm using Zoom here. I have another system that I use. I don't just get interviewed on the Seeking Alpha Investing Experts podcast. I asked them if I could interview some people. So for instance, one was coming out in the next few days, another one coming out in a few weeks. And the software I use for that is actually much better than Zoom. It records the whole thing. And it basically just pops it out there. So I may start to use that. I don't know if I can use it to record these, but let's put it this way. We will make sure that no subscriber is left behind, if you will, when it comes to that. Yeah, I mean, this is designed to, yes, it's for the masses, but at the same time, just like our advisory practice was back in the day, people tend to know us, and we at least know who they are, and it's it's collaborative. Like I said, it's not a mass market subscription service where you can get Rob's best picks for $2 a month. There's plenty of that out there. World does not need another one. Okay. Any other questions? Otherwise, we'll call it here, and we'll pick it up next Monday and in the chat and everywhere else. Anybody else?
Merry Christmas.
All right. Yeah. Merry Christmas and happy holidays to everybody. And when we get back here next year, guess what? It'll still be 2024, but I'll go in a little bit more, and I'll probably highlight some of the new features of the site too. Okay. Thank you all. Thanks for the time.
Thanks, Rob.